And we are live. It's showtime, 11 o'clock, Wednesday morning. It's webinar time, Masterclass. Standardizing FX hedging from policy to execution without losing control. Really fancy title. It's all about FX hedging, standardizing, automation. Really happy to have my speakers here. A Treasury angle, Alexander Ilken, Treasury consultant, Treasury Masterminds board member. Erik de Boer from 360T. Everybody knows Erik as 360T. I think I've never seen you somewhere else, Erik. Good to have you here. And Erik from Finastra as well, TMS vendor. So we'll hear the automation angle, the TMS angle, and the data angle from him. Good to have you all here. Do not lean back. I want this to be interactive as much as possible. There is a chat function, so please use it to post your questions. Do not wait till the end of the session. If you hear something which triggers you, put it in the chat. Not only if it's a question, if it's a comment, put it in the chat, and we will definitely read it and comment on it or ask your questions either immediately or at the end of the session. And again, before we start, I have made a lot of questions for this panel, challenging questions, interesting questions, hopefully. But I want to start with a poll question to you, to the audience. We've more than 100 people registering for this webinar, so I want your opinion. It's a very basic question, but let's see what you think about this. How standardized is your FX hedging process today? Do we have the unicorns here who say it's fully standardized, everything is automated, everything is perfect? Are you a bit more honest, partially standardized? Is it fully manual? Is it ad hoc? Or is it option 4? It depends who is in the office. Quite curious to hear your answers here. Before we see the answers, Erik de Boer, what do you think the winning answer will be?
Partially, I think. It's most neutral. Yeah.
It's most neutral. Yeah. Do you think there will be people who say depends on who's in the office?
I hope not, because then they have the wrong people in the office, but I don't. No, yeah, right. Okay.
Very good.
100% manual. Oh, right. It surprises me.
It surprises me as well so far. Alex, what do you think? What should it be, Alex?
I personally feel that the hedging process should be standardized to the as full extent as possible. We should be able to identify the exposures, work with them, reduce the risk consistently. Because one thing that really wins the day in FX hedging, that's consistency, right? So you need to be consistent at what you do, because if you don't, then that leaves room for inefficiency in your risk management process.
Eric from Finastra, do you think it's even possible to have it fully 100% standardized, automated?
So before answering that question, let me share our experience across our client base. We can see 3 primary types of FX hedging policies. One which is more practiced by B2B corporates with a micro hedging, and this is quite simple to understand. An aircraft manufacturer is hedging each individual aircraft separately. Second one, which is macro hedging, more for B2C corporates, and here we are those type of companies are selling big volumes of goods, and micro hedging is definitely not possible in that context. And then we have a third model, which consists of replicating the FX fixing rate through spot transaction on a daily basis to hedge the variation of daily positions. So based on those three models, I would say that the last one could be fully automatized because you standardize the hedging instruments. You have one single type, which is a spot transaction, and the most simple one. You standardize also the way you are identifying your underlyings by aggregating all underlying position and booking those positions at the daily fixing rate. And this is what the treasurer needs to hedge on the market. So this one, I guess, is the most the model which allows a full automation. The two other ones, even though it seems to be consistent across corporates, it introduced three main areas where you can have some differences. So first, the hedging instrument, as I was saying, if you introduce, let's say, structured product with options, then you are complexifying your follow-ups, your monitoring, and of course, this family of instruments are quite wide, and you are over-complexifying everything. Then you have the definition of the underlying exposure. That could be, I would like to defend only my accounting P&L. I would like to defend all my economic exposures with the objective to protect margin. So here you have some differences as well. And finally, the regulatory environments. Some are subject to IFRS, some are not subject to IFRS. And depending on this, you can net or not your exposure. So I would say it depends a little bit on the model you are using.
Yeah, no, makes a lot of sense. Alex, when you hear this, I think Eric mentions the ultimate goalpost, full standardization, everything is automated, the world is amazing. You're a treasurer, you're a treasury consultant, you've seen a lot of setups. Where does this automation standardization breaks in practice? We don't want to hear only the success stories. We hear the non-successful stories.
Yeah, I think I will start with reflection on what Eric said, and I would take a slightly different angle. Yes, as treasurers, we are focused on economics, but it is the financial volatility that we are managing, and therefore it is important to look at accounting impacts as well. And there you make a decision like, what exactly do you hedge? And that boils down to the policy. Do you hedge your balance sheet? Do you hedge your net investment? Do you hedge your forecasted cash flow, or P&L in other words, right? So, and those are three distinct models, right? Three distinct things that you can hedge. And as a result, those three approaches that you mentioned, micro, macro, and daily hedging, I would essentially ask, hey, why do you need daily hedging? If your balance sheet, for example, isn't as volatile, you can do monthly, right? You can do maybe weekly, right? If you needed to, but we certainly are on the monthly accounting cadence, right? So monthly is probably the most reasonable because that's when you know what the exposures actually are. Now, if I think about automation, then there are kind of chains in this value chain, right? So you identify exposure. If we're talking about TMS, you load it in your TMS, you quantify your risk, you execute, and then afterwards you get the results. You need to monitor what's happening with your, say, FX gain loss if we are talking about balance sheet hedging, right? Now, each part of this chain can break, right? So yes, it's possible to build automation so that you can get the data, it's loaded into TMS, something is happening in TMS so that it throws at you what the risk is, right? You execute, and then afterwards you monitor. And within each of these steps, you can have breakages. In practice, the step that I see that is typically manual is going into TMS and actually performing valuation of risk. Because very often this is based on the user interface, so someone needs to go in there and click the buttons, right? So that's where the process is typically manual. And if you're in a SOX controlled environment, this is where kind of you need someone to calculate the risk there. the part of getting the exposure, even automating the initial hedging proposal, getting the proposed hedges into the system, I've seen that being automated. And where it may break sometimes is when you have upgrades to the underlying technology, right? So the technology you're using is getting upgraded from time to time. So you need to make sure that you do regression testing and make changes so that you're able to support that. So that's one that's kind of systematic technology related. And then the second one, if there are any reports that people are downloading, especially manually, but also sometimes in a technology way, there are slight changes that may break the process. Like, for example, someone else is running the process, depending on who is in the office, going back to your poll question, someone else is running the office, and in their user interface, the decimal delimiter is not a dot, it's a comma. That will break automation, right? Or technology vendor decided that they want to standardize how the columns on technological fronts are named, and they started capitalizing the column name, right? So those are the things that may break. Automation depends on the system being, on the process being exactly the same, the data being exactly the same very often.
Okay. Yeah, that's quite interesting. Eric B, hearing that, being at 360T, you probably see many setups. Do you see inconsistencies between how corporates execute their hedges?
Well, not execute, because they do all the same, yeah, basically. But how they prepare. Execution is just an RFS, it's sent it into the marketing competition, and then you get a price, it's done. Yeah, very clear. But how do they prepare? And what I mean is, indeed, do you do it manually? Do you do an upload from a system, which is just a file import? Do you have an interface? Yes or no? Depends on the business as well. Yeah, if you are a commodity trader, it's completely different, because then you have an underlying contract which can change in the meantime. So then you have to roll, or you have to do it early. So that's completely different. Also, when you did the execution, or just before the execution, you can check. Yeah, you have additional checks. So it's not only the TMS, but in an EMS, an execution management system, you have additional checks. So the first thing you check is, okay, how many banks do I have in my basket? Do I want to change that maybe, because bank basket optimization before I execute? Do I do a check in the market? Yeah, and I think we're coming back on that later on. Do I have the right data to do that check? Yeah, is that valid data? If you have data out of the market, you can make a huge mistake. So that's also important. So yeah, it differs from company to company how sophisticated they are. But yeah, eventually, an execution is an execution. Yeah, right.
Oh, fair. That's the easy part. I think introducing this session, I made a LinkedIn post where FX hedging is easy. It's just pushing a button. I just have to make sure bid ask left and right. I know the difference between them. Quite important.
Exactly.
Fully agree here. Eric A, listening to that, treasurers do have a policy. We have a treasury policy, we have an FX policy, which exactly tells me how I should hedge. I hear from Alex, I hear from Eric. In practice, it never works that way 100%. What gaps are you seeing between policy and execution, especially from a TMS perspective?
The difference between the two is coming from how the underlying is presented and how is it calculated in order to take the right decision for hedging. So the execution is part of the whole workflow, and we think that from a TMS perspective, we should see the implementation of such a tool holistically. So what do I mean by this? I mean, for the margin protection, there are many stakeholders that should intervene into the FX workflow. So we identified 3 of them: the controller, who is responsible for the overall P&L and also to request hedges because they are working with the commercial teams closely. We have the accounting profile, which is ensuring the accuracy, the compliancy, and the consistency of methods within the general ledger. And then, of course, the treasurer, who is responsible for executing hedges at the best market conditions. And here comes the execution part. And this is this cross-functional approach that we are sponsoring in our TMS by proposing a combination of organization and TMS functionalities in order to serve everyone. Okay, so if I take an example, a very simple example, we have implemented recently a B2B corporates with 5 standardized areas. First one, which is related to data integration. So here the idea is to collect the data from the underlying data from the ERP systems. We need to structure, aggregate those data per business unit, per currency, per everything which could be relevant for that corporate. And of course, and most important, to manage the life cycle of that underlying. I mean, we need to manage the transition from orders to invoices to settlement. And at each transition, there could be some decision to be made on the hedging side. So this is the first area. Then there's the second area, which is related to governance and validation. In the end, the treasurer is here to execute at the best cost. But what is exactly the amount to hedge? We think that the best role to take this decision is the controller, because he is the one who is providing data to the commercial team. And we are asking this role to enter hedge requests. And then comes the third and fourth pillar, where there is a treasurer team, treasury department who is entering into actions. First for the deal execution, so on the front office side. And here we are proposing a full integration with 360T in order to have within one single UI, so the one of the TMS, to receive the codes and choose the codes at the choice of the treasurer and execute from that. And based on this, we can also set up some automated rules, such as, let's say, below $10K, I don't want to have a manual intervention. So let's make the system execute automatically this hedging. And then we have the back office and the accounting. So we did something similar with CMS, which is a matching system. And once we get the matching status from this tool, we are able to process the settlement automatically. And of course, at the end of the day, create the postings to interface into the general ledgers, the P&Ls of the hedging transactions. And the fifth pillar, and maybe the most important one, is everything which is reporting and performance measurement. Here, we have a set of reporting to first give a full visibility on the back-to-back positions, just to be sure that we are properly hedged, of course. And we are providing multiple P&L views, one for economical monitoring. Here, the idea is to measure the hedge effectiveness against the orders. The same approach with accounting. Here, the same story, but we measure the hedge effectiveness against invoicing. And then the treasury, P&L, sorry, where we are measuring the cost and performance of the hedging execution. And this is, we think, this whole combination that make hand-to-hand process efficient and consistent.
Yeah. It makes a lot of sense. This is a great answer, Eric, because I think if we talk about FX hedging, we all think about going into 360T, doing a deal and buying and selling, and that's it. But that's definitely not it. It starts with the data, which you rightfully say. The data is never almost never owned by Treasury. It's coming from different departments. And then even if you have done the hedge, you need to admin the hedge. It needs to be in the TMS. It needs to be in the back office. And then Treasury has the information. It needs to be settled, aligned with the banks. You mentioned CMS. For me, it's MySys forever. That's how it started for me. It's called Finastra now. And then the last step, often underestimated a lot, the back office part, the accounting part, going the deals into the ERP system, the accountant thinking like an accountant, the treasurer thinking like a treasurer with market to markets, where accounting thinks in month-end closing. Very important points here. Alex, hearing this, that means we can almost never fully standardize, but I'm hearing policy, I'm hearing data, I'm hearing systems, but it's also a people business. Many layers are involved. Is it a combination of all four of these which needs to be perfect? Which one is the most important? Where should we focus on?
Yeah, I think the person that is involved in this process is essentially the glue, the person or the team, right? The people really glue everything together, and it's on the people that it depends how efficient and effective your hedging program is. One thing that I definitely know from my, I think about 15 years in Treasury, is that we in Treasury are the last in this pecking order of any transaction that's happening. We are the last ones to move the cash. Same here with hedging. We are the ones who are executing the hedges. No matter what you do, if something goes wrong, people will ask you, why did you execute this? And so the buck stops with us. And therefore, because it stops with us, I don't think that we are able to delegate the responsibility of requesting hedges to someone else. Right, there needs to be someone in the room who understands the end-to-end process, right? So starting with the policy, right? So the policy needs to be there in place, and the policy identifies the boundaries, right? What it is that you are doing and what you are expected to do. If your process doesn't follow those boundaries, you do have a problem, right? And that problem may boil down to people not following the standard procedure, or it may be that in reality you're doing something differently than what the policy states, which is a problem. Then you need to either adjust the policy or what you actually do. So I think, you know, data does come from somewhere else, and this is where accounting or controllership, depending on how they're called in the organization, they are responsible for ensuring that the books reflect the reality, right? And this is important. We in Treasury, we are consumers of that accounting data to identify the exposures and then hedge accordingly. So we need to depend on that data being correctly entered in the books. But I would say that from my perspective, how I typically try to build the hedging processes, the treasurer is the person who needs to understand the process end to end. You need to know what's happening in the business so that you can understand what the exposures are, take action accordingly, and then also understand what's happening with your FX gain loss. Because imagine your CFO comes there to a finance meeting and says, we have a 10 million hit this month, 10 million loss in our P&L. Why? Who do you think that person will be looking at, CFO will be looking at when asking that question? I'm pretty sure that will be a treasurer, because treasurer is supposed to manage the risk.
Often, yes, unfortunately. And then it turns out it's unrealized FX gains or losses, which is an accounting thing or an EBITDA thing. It's not even a real cash item. But
well, if they are unrealized coming from derivatives, they should be offset by the hedged item, right? So if it's balance sheet, then the offset will be revaluation of your foreign currencies, right? If it's forecasted cash flow, then it will be changes in your P&L items that you're hedging, right? So
No, definitely. Fully agree.
I think, if I may, there is a gray area when we come to orders, specifically for B2B corporates. When the commercial teams is selling to a client, they agree on several milestones, on a price, of course, and within that price, you have an hypothesis of a fixed rate, right? And this is at that time that some treasurers are starting the hedging process. And at that time, there is nothing yet in the books. And that's why we should, in this particular context, and maybe this is not a rules for everyone, we need to involve someone else than only the treasurer. The treasurer cannot be responsible for that, you know. That's maybe one exception.
No, I fully agree, and I like what you are saying, Eric, Alex. Treasurers at the end of the line, but not fully responsible for the full process. But because we're at the end of the line, we are the controller, sort of, and responsible. Yeah, that's quite interesting. Eric B, looking at you, would you see differences between regions? You're responsible for the Benelux, maybe a bit of Nordics. Is it done differently in southern parts of Europe or LATAM, Asia, or should we all go full automation?
On corporate level, definitely there's difference between the regions. Okay, in the Netherlands, for example, we are automized, and when you go to Spain, you have a very long dinner with your counterparty. So that there's a massive difference still. It's changing slowly, I see, especially in the south of Europe, that they see that it's not working like that anymore. Yeah. So, but if you take that in the northern part of Europe, I think it's basically the same.
Okay.
Basically the same. Yeah.
Interesting.
On the other hand, we want to step back. To protect your treasury a little bit, you can implement the 4I principle. That's what a lot do. So before you start executing, it's going to another person in the organization who has to sign it off, and then you can do it, or he can do it himself. So there are protections possible.
Mm-hmm. No, definitely. But then all these policies, Eric A, all these policies, nice, of course, they make sense. Standardized, it's policy, workflows. I hear you, and it makes sense. But isn't it slowing Treasury down? We're small teams. We want flexibility. How about this flexibility versus standardization?
This is true that it's quite the opposite. So I would say that if a policy is defined in a way that you have rules that are repeatable, no manual intervention could be then achieved, and then you can reach a full automated workflow. If not, of course, you need to set up some workflow in order to have space for human decision. So I would say, to answer your question more directly, it really depends on how the policy is built. And the system will just reflect what the policy is stated, in fact. And at the end, what we need to be careful is the goal of each corporate is to grow, of course. And the perimeters are changing, perimeter in terms of region, like Eric B was describing. And maybe potentially the business rules that has been set up at one point in time may not be valid in another point in time. And this needs to be reassessed on a regular basis, just to be sure that what has been defined as automated could still be the same in another context. So that's we can advise.
Yeah, makes sense. Eric B, standardization, automation, is it good for pricing or bad for pricing?
Depends. If you send out netted positions, yeah, it could improve the pricing. That makes sense, yeah. because there's bigger amounts, you get a better price. Depends a little bit how you want to do it. If you want to do it for multiple entities at the same time, which is sometimes a little bit difficult because they all have their own bank accounts. So it's possible technically to send it out to the bank first, and then it will be divided over the other over the underlying entities afterwards. Or you can do an allocation when they don't have their own bank accounts. So you do the trade, the netted trade, and you can allocate it to the underlying entities in the TMS. Yeah, so there's two differences. And yeah, of course, when you do contracts individually, I think you get a worse price.
Yeah. Okay. Interesting. Alex, hearing this, where should we focus on? Is it then exposure identification? Is it the hedge decision? Or is it like Eric says on the execution side? Please don't say combination of all three.
I'll add the fourth one. I'll throw in the fourth, and this is what happens after we hedge, right? Because we talked so much about what happens before, but the important thing is also monitoring what's happening afterwards. Because in my experience, when working with multinationals in particular, what happens after is quite important, but is very often overlooked, right? So if you're saying that you're managing your risk to be below $10 million a year, for example, then you should show that you're actually achieving this, right? So because otherwise, how do you monitor how successful your hedging program is, right? How do you make sure you learn from the mistakes in the process, be it on treasury side, on accounting side, anywhere? How do you learn from misforecasts, right? If we are talking about forecasted cash flow program, so you really need to be focused on those inefficiency sources to identify where those are coming from, so that you can over time deal with these problems as they arise, so that they do not come back afterwards unsolved, right? So you need to identify the root cause, you need to fix it, etc. And this is where I feel a combination of skill sets from treasury combined with accounting becomes extremely important. Because if you're a treasurer, then you know treasury stuff. If you're an accountant, you know what's happening in the books. Being able to match the two and really say, you know what, we need to reduce our FX gain loss. We are there. That is worth a lot when you're able to have that kind of conversation with your CFO and essentially say, while policy says this is the limit, and we are able to show in our financial reporting we're actually getting there, right? So I think that's the fourth component that you didn't mention, that I feel is extremely important to make sure that your hedging program stays valid over time. You reassess its validity, and importantly, you're able to develop a story internally to show the internal world, finance organization, or the businesses why what Treasury does is very important. Then we're able to descend from the ivory tower that we are very often seen in, and be there with the internal stakeholders, be there with the business, right? Be with them and help them, right? So we do need to become treasury storytellers to a great extent, and
Yes.
that's only can be done if you know what's happening in
Yes.
the books afterwards, if you manage those KPIs.
Yes.
Completely agree with that one, yeah. Completely agree. What I see often that is lacking. The real big ones have programs for it. You've got Virtue, you've got trade feeders, which are TCA, transaction cost analysis packages, where you can just input the data from 360T automatically on an XML format, and you can do your analysis easily. And I don't see that very often, to be honest.
Yeah, I tend to agree what Alex says here. We're the technical guys. For us, FX hedging is easy. We juggle all these TMSs, these weird strangles, straddles, butterflies, but even a spot and forward transaction for the average finance guy is unclear what the difference is. So we need to go out there and understand maybe we need to understand our data first. Why are we hedging these amounts? What are we actually hedging? What's my exposure? And then go back to the business and tell them our added value. We hedged, so we saved you 20% of your margin, or we made sure that 100% of your margin is fixed. I like this treasury storytelling answer there, Alex, which is difficult. Treasury teams are small. So Eric A, we need a bit of automation here then. So we need you guys to help us out, tell this story. So maybe in a bit more detailed, how do we do this? How do we connect exposure data, hedge decision, execution, and reporting in multiple flows? Is it possible?
No, definitively the end target will be to have one flow. So just to comment, you exactly describe what is the main problem we need to address with the TMS. The role of the TMS is to collect data from multiple systems, generally ERPs, aggregate those data per business unit, exposure, whatever is relevant for the corporate, and then present it to automate the hedging process and send back the result to the ERP system. So you have input, processing, output. And basically, what does it mean? The TMS needs to be connected with several systems, ERPs, market data provider, dealing platform, confirmation matching platform, ERP again for the accounting side. And we can see that the TMS is playing a role of coordinator in between several systems. And if we are able to connect all those systems in a particular way, and I'll come back to that in a few seconds, we are able to achieve into one flow the full process. And this is possible with API. In fact, the technology is helping us a lot here in that context, and this is what we did with 360T, with CMS on one side. We have connected our TMS with using APIs, and doing so, we are able to standardize interfaces on one side, and more important, we enable real-time interaction, and which in turn allows the automation of processes involving several systems. So that's how the way we are seeing it. This is, if you allow me a short parenthesis, this is also how the TMS will evolve in the future. We will see, I think we will see more and more business process monitoring features. You know, if we want to automate everything, we need to be connected real time using APIs. Once done, we need to, as Alexander was stating some minutes ago, we need to control, to check that everything is going well, because if there is a change in the scope or perimeter or whatever, the rules that has been defined could not be efficient anymore. And this is possible with tools that are existing on the market, business process monitoring, but not yet available in the TMS. And this is what we think will be the future. And then the next future will be to leverage AI capability at some point, maybe to take decision on behalf of humans. Why not? And here we would be able to address any type of policies, even those that are involving human decisions. Okay, but this is another step.
Yeah, no, of course, AI is really maybe phase 5 of the automation part. Let's do stage 1 to 4 first, where we improve processes, know our story, like Alex says, and maybe even then have AI do our decision making. I'm not sure. I wouldn't trust it, but that's my personal opinion. Eric B, hearing this from Eric A, Is full connectivity the future? Do you see 360T being connected to ERP systems directly, to TMSs, not only push-pull, but really real-time information coming in the TMS, being updated from the ERP, rules, automations, and 360T executes with or without human interaction. I don't want to say the 24/7 word because I do want some sleep and some weekends. But is this the future?
It's there already. It's there already. We see clients who do not log into this 360T anymore, to the EMS system, because it's all automated. It's coming from a TMS. It's coming in. The rules are there. They check if the banks are sufficient. They check a tolerance with a certain rate. It's executed. It's going back into the TMS. And it's going to be confirmed by Finastra in this case, because we work together with Finastra. And that's it. So you have 2 people less in your treasury, basically. Yeah. It happens already today.
Great. Alex, is this what we want? Everything in one system, connected tools. The world is amazing.
I would say that it will be a long time before we reach the place where we can get rid of treasury people once we automate the processes. Let's be honest, treasury teams are very lean. There is a lot for us to do, right? So we can shift our attention to something else, right, that deserves that. And that is, for me, that is a great place to be, right? Where you can actually do something else as opposed to something that was just automated. So yeah, I think, and that also brings us to the point that we need automation, right? Because again, for the same reason, we are small teams, right? We are not outblown, right? We are typically small teams doing a lot, and therefore automation is necessary. And thankfully, the technology is there to help and support us. In terms of how much technology or how many different technology tools you need to have in your basket, I would be an advocate for selecting those solutions that are best in class, best tailored or appropriate for what you're trying to accomplish, right? So 360T execution, Finastra, right, from TMS perspective, that's great. If those are the two tools that you've selected, there is little reason to have another TMS solution, for example, right? So you kind of tend to select those solutions that fit the purpose for your business, right? Because let's be honest, working with any solution, any vendor, I always liken it to marriage. You want it to work and you want it to be long-term, because divorce and changing your partner somewhere down the road is very, very expensive and painful.
Yes, interesting analogy, Alex. Fully agree. Let's go to, we have 2 audience questions there. I like the first one. How often do you update your policies? I don't want to go there every year, but I don't want to go there every 5 years. I definitely want to go there with every war in the Middle East. Who has an opinion?
I think I would offer one, just as practitioner now working with multinationals. I would say the policy should be as stable as it is possible, right? Because typically the policy should be set at sufficient high level so that they capture wide varieties of what is happening in the market, right? So yes, there may be reasons for you to adjust the policy, but you really ought to ask yourself, hey, did something fundamentally change, be it in the business, maybe in the markets, right, that you really need to change the policy. From a FX risk management standpoint, I feel it's fairly straightforward. From my perspective, if you do value at risk valuation, right, you set a certain tolerance. That is typically when you start getting questions from CFO, right, or where does the board start asking questions, right? When people start hearing those alarm bells go off, right? That indicates, hey, you reached your tolerance limit. So you set your policy to essentially be in line with what the risk appetite is, and that wouldn't change very often, to be honest, right? So your policy can be fairly stable. You don't need to revamp it every year. I would advocate that you need to take a look at it, at least on an annual basis, to see if it's still if it requires any small tweaks, right? Even if you just validate, yeah, the policy is still sound and valid, that's fine too, right? But that's a good rhythm to have.
Yeah. I like that. I like that. That makes sense. Final question from Andrew: how do you demonstrate the value add of having hedges versus not having hedges? Not having one and full range of market outcomes. Yeah, so full exposure. Can we demonstrate that? Maybe one of the Erics.
Not a question for me, to be honest. It's more a business question. So I would prefer to get it to Alexander. I don't know, to be honest.
All right. Yeah, I can certainly. Andrew, thanks for that question. Because I think that's a very important one from Treasury storytelling perspective in particular. The way I look at this, it's easy to demonstrate the value of hedging, right? So you essentially, at the point when you're executing the hedges and you don't know what the outcome will be, again, value at risk is my preferred method, right? So you're able to calculate your exposures when they are not hedged. That will have a risk, let's say 60 million over the next 12 months, right? Then you say, okay, we want to bring it down below 10 million. So you take into account your residual exposure after hedges, you calculate the risk, let's say it's 7, right? And that becomes a very clear story to your CFO. Hey, in 95% of scenarios, you may have lost 60 million over the next year, but with the hedges, you will only you're only at risk of losing below 10, right? So that's a clear story at the point of execution, and then you can translate that annual risk into quarterly, into monthly, so that you can use it for monitoring as well, which is important. But then after you execute and you have your hedging program run for some time, that's where it's important to monitor what your actual impacts are, right? Because then you're able to show, hey, let's say for balance sheet hedging program, our revaluation without hedges would have been X. It has been reduced. The actual FX gain loss impact is reduced to Y. You calculate, say, standard deviation, and you just show, hey, it was reduced to that amount, and it's in line with the policy. So I feel as long as you, and that's where continuous monitoring is important. As long as you monitor, you have the data, and then you can use that data to substantiate your story, and that becomes a success story, hopefully.
Yeah, no, I agree. Maybe then final question, which triggers me, Eric A, is this something we need in a TMS then? This storyboard, FX storyboard, actual versus hedging versus non-hedging, value at risk.
Well, the TMS is supposed to reflect the policy in place. So, of course, we cannot implement a TMS without having a proper hedging policy in place. So, that's quite obvious. Now, to answer to Andrew, and if I may complete the answer of Alexander, let's take an example, very simple example. Okay, so your core business is to sell goods and services, right? You are performing a 10% margin on selling those goods. You are exporting those goods in foreign countries. What happens if the currency pair is increasing by 10%? Fair enough, you are winning an additional 10%. That's perfect. What about if it's go in the inverse way? You have eaten your whole margins, your whole commercial margin, your core business, just because of the variation of FX rates. So looking at this, I think there is no possible discussion. Here, the hedging, FX hedging is like an insurance to keep your margin at the level that you are expecting for.
Yes. No, that's the one-on-one of hedging. Yeah?
I would totally agree, and I think it's very much relates to what Michel pointed out there in the comments. CFOs understand only when the hedging is beneficial, and here it's important to define the word beneficial. What is the benefit? The benefit and the success of hedging program is not when you gain on hedges, right, to offset the losses on the underlying hedged item. The real benefit is reduction of volatility. You know with better certainty what the result is going to be, right? So the actual result will be based on the market volatility. You may lose some money on the hedges, and therefore you gain on the underlying item. You may benefit maybe the other way around, but your nirvana is the FX risk management manager is less volatility. If you're able to show that, that's the benefit. And this is the storytelling / educational component there, because it doesn't come naturally to people. People's reaction still is, oh, we gained on hedges, great. If we lost on hedges, then it means if we didn't hedge, then we would have had bigger margins, right? But yeah, that's true. But if you leave your business open to that risk, that becomes a gamble, right? That becomes a casino. Why do you need that in your business model?
Yes, no, fully agree. We're treasurers. Treasurers are risk managers. We're not reward managers. We don't have EBITDA responsibility or anything near that. We should be touching that. Great points. We've run over time a bit. It means the topic is hot. I think we can talk for 1 more hour if we want about FX hedging, standardization, and automation. It's definitely one of the most interesting topics in Treasury. Thanks for your inputs, Alexander, Eric B, Eric A. Amazing for having you here. The audience, thanks for being here. Thanks for making this interactive, asking your questions and your inputs. If you still have questions after the webinar, feel free to reach out to us. If you have questions to Finastra directly, reach out to Eric directly. If you have questions to 360T, reach out to the other Eric also directly. They are very open and welcoming your question and answering them on a one-on-one basis. For now, that's the end of the webinar. Stay tuned for more webinars. We have 2 more upcoming in June and 2 more in September. So keep connected to Treasury Masterminds. For now, thanks for joining and enjoy the rest of your day. Thank you.
Thank you.
Thank you.
Thank you.